There's a specific kind of silence that falls over a trading desk when the math stops working. It isn't the silence of boredom. It is the silence of realization. It is the moment when the screen says one thing, but the reality says another. Yesterday, that silence descended on the clearinghouses of New York. We are currently in a delivery month. For the tourists who only watch the stock market, this means nothing. But for those of us who track the plumbing of the global financial system, a delivery month is the only time the truth is allowed to peek through the curtain. It is the time when the paper contracts. The millions of digital promises that are traded back and forth every millisecond are supposed to stop moving. It is the time when the music stops, and the holders of those contracts have to decide, do I roll over into the next month, or do I stand for delivery? Usually, 99% of them roll over. They are speculators. They don't want 5,000 ounces of silver dropped on their driveway. They want dollar profits. The system is designed for them. It is designed to be a closed loop of paper trading paper forever. But yesterday, the loop broke. Here's the data point that the mainstream financial media is ignoring. They are talking about interest rates. They are talking about GDP forecasts. They are distracting you with the noise of the surface economy. But underneath the surface, in the deep plumbing of the COMEX, a tectonic plate just shifted. Yesterday, over 4,200 contracts stood for delivery. Let's stop and really look at that number. 4,200 contracts. In the silver market, one contract represents 5,000 troy ounces. When you do the multiplication, you're looking at 21 million ounces of physical metal. That is not a small number. That is not a rounding error. That represents roughly 3 weeks of total global mining production, demanded in a single 24-hour window. Now, in a robust, healthy market, the kind of market the regulators tell you we have, this would be a non-event. The exchange would simply look at its inventory, assign the warrants, and the metal would move from the seller's account to the buyer's account. But here is where the story changes. Here is where the glitch becomes a signal. I want you to pull up the daily warehouse inventory report. This is a public document. Anyone can read it, but almost nobody does. Look at the registered category. It didn't move. Think about the physics of that statement. 21 million ounces were demanded. The vault levels remained flat. If you go to a grocery store and buy every loaf of bread on the shelf becomes empty. The inventory number drops. If you buy the bread and the inventory number stays the same, it means one of two things. Either the bread miraculously replenished itself instantly, which is impossible, or, and this is the terrifying conclusion, you didn't actually get the bread. You got a receipt, you got a promise, or in the case of the COMEX this week, you got a settlement. We are receiving confirmation from multiple sources, commercial traders and wholesale desks, that a significant portion of these standing contracts were met not with metal, but with cash settlements. This is what we call a soft default. A hard default is the end of the world scenario. It's when the exchange locks its doors, declares bankruptcy, and the legal battles begin. A hard default destroys the system instantly. The system managers, the banks, the exchange, the regulators, will do anything to avoid a hard default. They will bend every rule, twist every regulation, and print every dollar necessary to keep the doors open. So they choose the soft default. A soft default is subtle. It is bureaucratic. It is when the exchange invokes a clause in the fine print, a clause you probably didn't know existed, that allows them to say, due to market conditions, we cannot deliver the physical commodity. We are exercising our right to settle this contract in cash at a determined fair value. They force the buyer to take fiat currency instead of the hard asset. To the outside world, the trade looks settled. The books balance. No laws were technically broken because the fine print allows it, but structurally, the function of the market has failed. The market exists to price and deliver silver. If it only delivers cash, it is no longer a silver market. It is a derivative of the dollar. This week, we witnessed the most significant soft default event since the nickel squeeze of 2022. And just like back then, the majority of investors are sleeping through the alarm. To understand why this happened now, we have to understand the mechanics of the squeeze. Why did 4,200 contracts stand for delivery? Why didn't they roll over like they usually do? This wasn't an accident. This was a calculated attack. The entities standing for delivery, the longs, are not day traders sitting in their basements. You do not stand for delivery of $20 million worth of silver unless you have an armored truck and a vault ready to receive it. These are industrial giants. These are sovereign wealth funds. These are the smart money. They know the data I'm about to show you. They track the registered inventory just like we do. Look at this drain. This is the heartbeat of the crisis. 5 years ago, the COMEX registered vaults held over 150 million ounces of silver. That was the buffer. That was the insurance policy. If a big buyer came in, the exchange could easily satisfy the demand. But month after month, year after year, that buffer has been eroded. It has been hemorrhaging. We watched it break below 100 million. We watched it break below 50 million. And now, We are hovering at levels that are statistically insignificant compared to the paper leverage. The smart money watched this drain. They waited. They waited until the inventory was so thin, so fragile, that a single large order could break the back of the available supply. That order came yesterday. It is a strategy known as cornering the float. In the stock market, the float is the number of shares available for trading. If you buy up the entire float, the short sellers, the people betting the price will go down, are trapped. They have to buy from you to close their positions, and you can name your price. In the silver market, the float is the registered inventory. By standing for 4,200 contracts, these buyers effectively tried to buy the entire remaining float of the exchange in one swing. They tried to break the bank. The cash settlement was the bank's defense mechanism. It was the emergency brake. But here's the catch. The emergency brake only works once. When you force a cash settlement on a buyer who actually needs the metal, say a solar panel manufacturer who needs silver paste to keep their factory running, you solve the paper problem, but you create a physical problem. That buyer still needs the silver. They didn't want the cash, they wanted the atoms. So what do? They take the cash settlement, which is likely millions of dollars, and they go immediately into the private market. They call the refiners, they call the wholesalers, they call the miners directly, and they say, I have cash, and I need metal now. This creates a secondary shockwave that is invisible to the COMEX data feeds. It creates a panic in the physical supply chain. It drains the private stockpiles. It creates a bidding war in the shadows. So, while the spot price on your screen might look stable, managed, suppressed, capped, the real price of physical silver is decoupling. We are witnessing the birth of a two-tiered market. Tier 1, the paper price, which is managed, cash-settled, and increasingly irrelevant. Tier 2, the street price, which is volatile, scarce, and dictated by the laws of physics. This week's delivery failure was the moment Tier 1 admitted it could not satisfy Tier 2. I want to get technical for a moment. I want to show you the check engine light that was flashing before the engine blew. It is a phenomenon called backwardation. If you are new to commodities, this concept is critical. In a normal, healthy market, the price of silver for delivery in the future, say 6 months from now, should be higher than the price of silver today. This is logical. It is called contango. Think about it. If you want me to sell you silver in 6 months, I have to store it for you. I have to pay for the vault. I have to pay for insurance. I have to tie up my capital. So I charge you a premium. The future price is the spot price plus the cost of carry. But look at the curve from this week. We are seeing the opposite. We are seeing backwardation. The price for immediate delivery is higher than the price for future delivery. Why? Why would someone pay more to get the metal today than to wait? Because they are terrified that in the future, the metal won't be there. Backwardation is the market screaming about scarcity. It is the ultimate signal of physical tightness. It means that the utility of holding the physical metal right now is higher than the cost of storing it. It means that the market participants value possession over profit. We have seen temporary backwardation before. It usually lasts a day or two. But this curve has been inverted for weeks, leading up to the December delivery cycle. The insiders knew. The algorithms knew. They saw the registered inventory draining. They saw the backwardation deepening. They knew the default was coming. And yet, if you turned on the financial news networks this morning, what did you see? Did you see a breakdown of the COMEX delivery failure? Did you see an analysis of the inventory crisis? No. You saw a segment on tech stocks. You saw a debate about the Federal Reserve's dot plot. There's a deliberate blindness to this event. Because to acknowledge the failure of the delivery mechanism is to acknowledge that the pricing mechanism itself is broken. If the COMEX cannot deliver, then the COMEX price is not the price of silver. It is the price of a paper derivative that is losing its peg to reality. And if the world realizes that the silver price is a lie, then the rush to the exits begins. They are managing the perception of stability. They are painting the tape, but they cannot paint the empty vault. Let's talk about the human element, the psychology of the breach. Imagine you are the purchasing manager for a high-tech electronics firm. Your job is not to speculate. Your job is to ensure that the assembly line never stops. You need 500,000 ounces of silver every quarter for the conductive contacts in your devices. You played by the rules. You bought the futures contracts. You paid your margin. You scheduled the armored transport. You did everything the system told you to do. And then, on December 13th, you get the phone call. We are settling your contract in cash. The voice on the other end is calm, legalistic. They quote Rule 701 or Bylaw 4B. They tell you the money has already been wired to your account. But you don't feel relief. You feel panic because you have orders to fill. You have customers waiting. And you know that if you can't get the metal from the exchange, you have to go into the wild west of the private market. You know that your competitors just got the same phone call. You know that 5 other purchasing managers are frantically dialing the same refiners right now. What happens to your price sensitivity? It vanishes. Yesterday, you cared if silver was $58.50 or $58.60. Today, you don't care if it's $65 or $70. You just need the metal. This is how hyperinflation in a specific asset begins. It doesn't start with money printing. It starts with a loss of faith in the supply chain. When just-in-time delivery becomes not arriving at all, the psychology shifts from efficiency to hoarding. This week's soft default has shattered the illusion of just-in-time availability for silver. The trust is gone. And once trust leaves a financial market, it does not return quickly. It leaves a vacuum that is filled by volatility and fear. The buyers who were cash settled this week will never rely on the COMEX again. Next month, they won't buy futures. They will buy physical. They will secure offtake agreements directly with miners. They will remove their demand from the visible paper market and move it into the opaque physical market. This drains liquidity from the exchange. It makes the paper market even more fragile. It is a death spiral for the derivatives exchange. The more they default, the more buyers leave. The more buyers leave, the less physical metal enters the vaults. The less metal in the vaults, the more they have to default. We are watching the end of an era. The era of paper pricing is dying, and the era of physical discovery is being born. It is messy, it is volatile, and for those who are prepared, it is the greatest opportunity in history. But to understand just how deep this rot goes, we have to look past the registered numbers. We have to look at the lie that is hiding in plain sight. We have to talk about eligible silver. In the previous section, we exposed the failure of the registered inventory, the metal that is actually supposed to be for sale. We saw the cash settlements, we saw the soft default, we saw the math break. But whenever I point out the catastrophic drain in registered silver, the apologists for the status quo, the bank analysts, the mainstream pundits, always point to one thing. They point to the eligible category. They say, look at the total vault numbers. There are hundreds of millions of ounces ineligible. There is no shortage. You are fear-mongering. Today, we are going to dismantle that argument. We are going to perform a forensic audit of the eligible category and show you why counting it as available supply is the greatest sleight of hand in modern finance. To understand the deception, you have to understand the definition. And I don't mean the definition they give you on CNBC. I mean the legal definition found in the CME rulebook. Eligible silver is simply silver that meets the purity standards of the exchange. It is a 999 fine, 1,000-ounce bar, and is sitting in a COMEX approved vault. That's it. That is the entire definition. It does not mean the silver is for sale. It does not mean the silver is available for delivery. It does not mean the owner has any intention of ever letting it touch the market. Eligible silver is private property. It belongs to family offices. It belongs to long-term trusts. It belongs to industrial users who are storing it for future production. It belongs to sovereign wealth funds. Counting eligible silver as a market supply is like walking through a private marina, counting every boat docked in the slips, and claiming they are all for sale at the dealership. They are not for sale. They are just parked. And yet, the exchange and the mainstream analysts constantly conflate eligible and registered to create a headline number that looks reassuring. They report total exchange inventory to hide the fact that the liquid inventory, the registered stock, has evaporated. Look at this gap. This gap is the deception. When those 4,100 contracts stood for delivery this week, they couldn't touch the eligible silver. The exchange cannot legally seize private property to settle a futures contract. That would be theft. That would be confiscation. So the eligible pile sat there, massive, inert, and useless, while the registered pile failed. This proves that the total inventory number is a vanity metric. It is a mirage. The only number that matters is what is available at the current price. And that number is effectively zero. The owners of eligible silver are the strong hands. They are the ones who move their metal out of the registered category because they saw this crisis coming. They are not selling. In fact, they are likely the ones buying the scraps that remain. But the rabbit hole goes deeper. And we need to talk about the nature of ownership itself within this system. Because if you think the eligible deception is bad, wait until you understand the unallocated trap. Many of you watching this might think you own silver. You might have an account with a major bullion bank or brokerage or a digital app that says silver balance 1,000 ounces. But do you own the metal or do you own a claim? There are two primary ways to hold silver in the institutional system: allocated and unallocated. Allocated means there's a specific bar with a specific serial number sitting on a specific shelf, and it has your name on it. It is your property. It is segregated. If the bank goes bankrupt, that bar is yours. It cannot be touched by creditors. The bank is merely the custodian, the landlord of the shelf space. Unallocated is a different beast entirely. And unallocated is where the vast majority of the world's paper silver lives. When you hold unallocated silver, you do not own metal. You are an unsecured creditor of the bank. You have loaned the bank your money, and the bank promises to give you the value of silver back when you ask for it. The bank takes your money and uses it. They might buy some silver. They might buy treasury bonds. They might bet on derivatives. They are not required to hold 1 ounce of silver for every ounce of unallocated liability they sell. This is the fractional reserve banking model applied to physical assets. In a normal market, this works. People buy and sell the credits and nobody asks for the bar. The music plays. The fees are collected. But in a crisis, like the one we are entering now, the one triggered by the December delivery failure, the legal distinction becomes life or death for your wealth. If the bank faces a liquidity crisis, or if the COMEX fully defaults, unallocated holders will not get metal. Read your user agreement. It is right there in black and white. In the event of a shortage, in the event of force majeure, the custodian reserves the right to settle in cash. You will get a check, and you will get a check for the value of silver at the time of the default, which will be drastically lower than the true street price of the metal. Even worse, if the institution fails, you will be bailed in. You will stand in line with the other creditors, the bondholders, the vendors, the employees, hoping to get cents on the dollar. The eligible category in the vaults is often used to mask this liability. Banks will point to a pile of eligible silver and say, "We have the metal." But that same pile of metal might be owned by an unallocated client, while simultaneously being used as collateral for a lease, while simultaneously being counted as an asset on the bank's balance sheet. This brings us to the most toxic word in the financial lexicon, the word that turns a supply shortage into a solvency crisis: rehypothecation. Rehypothecation is the practice of pledging the same asset as collateral for multiple loans. In the silver market, it creates a multiplier effect on supply. It creates phantom silver. Let's walk through the mechanics of the fraud. Well, let's say a bullion bank holds one 1,000-ounce bar in their vault. They sell a futures contract against it to a speculator. They lease the bar to a refiner in Switzerland. They hold the bar as a custodian for an ETF. On paper, that one bar is supporting 3,000 ounces of market activity. The supply looks 3 times larger than the physical reality. This suppresses the price. If the market thinks there are 3,000 ounces available, the price stays low. It dilutes the value of real metal with fake paper promises. But what happens when someone demands delivery? What happens when we have a run on the bank? You cannot deliver the same bar to 3 different people. Physics is stubborn like that. The first person to demand delivery, the 4,900 contracts we saw this week, gets the bar, if they're lucky. The second person gets a cash settlement. The third person gets a lawsuit. This week's delivery failure, the cash settlements we discussed, is the sound of the rehypothecation chain snapping. The exchange had to cash settle because the metal wasn't there to satisfy the claims. The phantom silver evaporated, leaving only the real silver, which was insufficient. This implies that the open interest on the COMEX, the total number of open contracts, is a fraud. It is not a reflection of hedging needs. It is a reflection of naked short selling and rehypothecated leverage. We are watching a game of musical chairs where the music has stopped, and we are discovering that for every 100 players, there is only one chair. The eligible inventory numbers are artificially inflated by this double counting. We suspect, based on the failure to migrate metal into registered, that a significant portion of the eligible inventory is encumbered. Encumbered means it is already pledged to someone else. It is liened. It is leased. It is not free to move. So when you see 300 million ounces in the eligible column, do not think of it as a stockpile. Think of it as a museum exhibit. You can look at it through the glass, but you cannot touch it, you cannot buy it, and it will not save you when the currency collapses. So, what is the result of this eligible illusion and rehypothecation trap? It is the phenomenon we are seeing right now, the decoupling. We are seeing the bifurcation of the silver market into 2 distinct entities. The paper market. This is the COMEX spot price. It is the price of the unallocated credit. It is the price of the phantom silver. It is controlled by algorithms, margin requirements, and cash settlements. The physical market. This is the street price. It is the price of the allocated reality. It is the price you pay to hold a bar in your hand. Historically, these 2 prices moved in lockstep. The spread, or premium, was pennies. It was just the cost of fabrication and shipping. But as the risk of default rises, as the December delivery failure becomes common knowledge among the wholesalers, the spread is widening to historic levels. We are seeing premiums on physical bars explode. Why? Because the premium is the market's way of pricing in the counterparty risk. The premium is the cost of insurance. The premium says, this is the extra price you must pay to actually have the metal, and not just a promise of it. If you're watching the spot price and thinking silver is down today, or silver is flat, you're looking at the wrong metric. You are looking at the price of a swimming pool in winter. It doesn't matter what the price is if you can't swim in it. The real market is the physical market, and the physical market is screaming. Dealers are struggling to source product. The mints are on allocation. The delays for delivery are stretching from weeks into months. This is the shadow market emerging. The eligible silver in the vaults, that massive pile of private wealth, knows this. That is why it isn't moving into registered. The owners of that metal know that their physical bars are worth significantly more than the cash the exchange is offering. They are holding the aces, the exchange is holding the jokers. The eligible holders are sitting back and watching the paper market burn. They know that eventually the paper market will have to reset to the physical price, not the other way around. When that reset happens, it won't be a gradual climb. It will be a gap up. It will be an overnight revaluation where the spot price jumps to meet the physical price. The cash settlement event of December 13th was the warning shot. It was the system admitting that the paper price is too low to attract physical metal. But now we must turn our eyes to the only thing that actually matters in the long run. We are leaving the world of derivatives and entering the world of physics. We are going to talk about the Industrial Awakening. For 40 years, the global economy has run on a philosophy known as just-in-time delivery. It is an efficiency model taught in every business school from Harvard to London. It assumes that supply chains are unbreakable. It assumes that the market is liquid. It assumes that if you need 1,000 ounces of silver for your factory tomorrow, you can click a button today and it will arrive. This model works perfectly in a world of abundance. It works perfectly in a world of peace, but we are no longer living in that world. The December delivery failure on the COMEX is not just a problem for traders. It is a siren for the industrial giants. Consider the position of a major solar panel manufacturer. They are not speculators. They are not betting on the price direction. They are engineers. To them, silver is not a currency. It is a raw material. It is an ingredient. It is the most conductive element on the periodic table. Without silver paste, the photovoltaic cell does not capture energy. Without silver, the factory stops. If they cannot get silver, their billion-dollar assembly line shuts down. Their stock price collapses. Their government contracts are voided. For the last decade, these companies were happy to let the banks manage the metal. They bought futures contracts to hedge their costs. They trusted the paper market to deliver the physical product. But when the COMEX cash settles, when the exchange says, we don't have the metal, here is some fiat currency, the industrial user faces an existential crisis. Cash does not conduct electricity. You cannot build a solar panel out of dollar bills. You cannot solder a circuit board with a wire transfer. We are now witnessing the shift from just-in-time to just-in-case. We are seeing evidence, quiet, off-market evidence, of massive strategic stockpiling. Tech giants, EV manufacturers, and defense contractors are beginning to bypass the exchange entirely. They are realizing that the exchange is a broken tool. If the tool doesn't work, you drop it. They're going directly to the miners. They are signing offtake agreements. An offtake agreement is a contract where a company like Samsung, Tesla, or a major defense firm pays a miner up front to buy their entire production for the next 5 years. Why does this matter to you? Because every ounce of silver locked up in an offtake agreement is an ounce of silver that never hits the open market. It never reaches the COMEX. It never reaches the London vaults. It is removed from the global pool of liquidity before it is even mined. This creates a shadow supply chain. The visible inventory on the exchange is shrinking not just because people are buying it, but because the new supply is being intercepted at the source. The river is being diverted before it reaches the reservoir. The data on your screen shows declining inventories. But the reality is worse. The reality is that the inventory is being privatized. It is disappearing into the dark warehouses of industrial conglomerates who have vowed never to run out again. While the West plays paper games, the East is playing a game of accumulation. We need to talk about the Shanghai premium. For most of modern history, London and New York set the price of silver. They were the center of gravity. But in late 2025, that gravity shifted. The Shanghai Gold Exchange has been trading silver at a persistent structural premium over the COMEX price. Sometimes it is 10%, sometimes it is 12%. This is not an accident. This is a magnet. Capitalism hates a vacuum, and it loves arbitrage. If silver is worth $58 in New York and $66 in Shanghai, what happens? Physical metal leaves New York. It flows to Shanghai. We are watching a massive migration of 1,000-ounce bars. They are being loaded onto ships and planes, leaving the vaults of J.P. Morgan and Brinks and heading east. But here is the catch. Here is the part that most analysts miss. When a standard good delivery bar arrives in China, it is often melted down. It is recast into kilobars, which are the preferred standard in the Asian markets. Once that bar is melted and recast, it is gone from the COMEX system. It is no longer a good delivery bar. It cannot be easily returned to the Western vaults without expensive reassaying and recasting. It is a one-way street. The West is bleeding its strategic stockpiles to the East, tempted by the arbitrage, blind to the strategic suicide of emptying the vault. China understands that in the next phase of the global economy, he who holds the physical assets makes the rules. They are trading their paper trade surpluses for hard assets. They are exchanging exports for ounces. The December delivery failure is simply the moment where the West realized the cupboard is bare. The metal didn't just disappear, it moved. It moved to stronger hands. This is geopolitical arbitrage. The East is draining the West of real money, leaving us with the paper receipts. This brings us to the economic concept that terrifies central planners: inelasticity. The mainstream economists tell you that if the price of silver goes up, demand will go down. That is how it works for luxury goods. If Ferraris cost double, fewer people buy them. But silver is not a luxury good. It is a strategic necessity. The amount of silver in a $1,000 smartphone is worth about a few dollars. If silver doubles in price, does Apple stop making smartphones? No, they pay the price. The cost is negligible compared to the final product, but the function is essential. This is inelastic demand. The buyer must have it, regardless of the cost. But we are approaching something even more volatile: Giffen good dynamics. This is a rare economic phenomenon, where demand actually increases as the price rises. Why? Because rising prices signal scarcity. As silver breaks out, as the delivery failures become public, industrial managers get scared. They see the price rising and they think, I better buy now before it doubles again. I better buy now before there is none left. So a higher price triggers more buying. This creates a feedback loop, a panic buying cycle from the commercial sector. We are not talking about retail investors stacking coins in their safes, though that is happening too. We are talking about corporations securing their survival. This week's soft default on the COMEX is the starting gun for that panic. The smart money, the insiders, saw the delivery failure. They saw the cash settlements. And right now, as I speak, they are on the phones. They are locking in supply. This leads to the unobtanium phase. This is the phase where the price on the screen becomes irrelevant because you cannot buy at that price. You see $60 on the chart, but when you call the dealer, they say, we have none. When you call the refiner, they say, wait list is 6 months. The price is not what the chart says. The price is what you have to pay to actually get it. And right now, that price is discovering a new reality. The COMEX spot price is becoming a museum exhibit, a relic of a time when you could actually trade paper for metal. The real market has moved on. So, where do we stand? Let's summarize the intelligence. We are looking at a convergence of forces that we have tracked on this channel for years. The supply cliff. Global mining production has flatlined. Ore grades are decaying. No major new mines are coming online in 2026. The geology is fighting us. The demand shock. Solar, EV, and AI demand is accelerating. The green energy transition is effectively a silver transition. You cannot have one without the other. The inventory drain. The registered vaults are empty. The eligible vaults are locked or encumbered. The paper cover is thinning. The delivery failure. The event we predicted is here. The COMEX has begun cash settling. The soft default has arrived. This isn't a theory anymore. It is a mathematical certainty playing out in slow motion. The system is designed to project normality until the final second. It is designed to keep you in paper assets, in dollars and bonds and unallocated accounts, until it is too late to switch. The soft default is the warning. It is the tremor before the quake. If you're waiting for the mainstream news to tell you to buy silver, you will be waiting until it is unobtainable. They will not tell you until the reset is complete. They will not tell you until the currency has already been debased to pay for the bailout. The window of opportunity to exchange depreciating currency for real strategic assets is closing. The premiums are rising. The inventory is moving east. The industry is panicking. This December will be remembered as the turning point, the moment the paper mask slipped and the world caught a glimpse of the empty vault behind it. Do not look at the price. Look at the ounces. This isn't financial advice. This is an intelligence briefing. The math doesn't lie. The geology doesn't negotiate. You have the data. Now you have to decide what to do with it.